At Insightful Value, we track companies that slip through the headlines but not through the cracks of real value. And right now, Innospec looks like one of those under the radar opportunities. The stock has dipped, and while that might scare off the crowd, for those paying attention, it could be a case of the market missing the bigger picture. This video is for informational and educational purposes only, not financial advice. If you find value in deep dives like this, hit the like button and subscribe to our channel. It helps a lot. Innospec is a global specialty chemicals company. It operates across three segments: performance chemicals, fuel specialties, and oilfield services. From fuel additives to personal care ingredients and drilling chemicals, it's a business built on innovation and efficiency across very specific industrial niches. While it may not sound flashy, this is a company that quietly powers parts of everyday life and heavy industry with precision. So, why has the stock been under pressure? Mostly it's short-term noise. The latest earnings report showed a dip in net income, primarily due to weaker demand in the oilfield services division. That's not surprising, given the cyclicality in that space. But looking beyond one quarter, Innospec still posted revenue of over $400 million, with healthy gross margins around 30%. The company remains solidly profitable and debt-free, with a strong balance sheet and consistent cash generation. Dividends? Yes. Innospec has been steadily increasing its dividend over the past few years. It's not a high-yield play, but they've raised payouts consistently without compromising reinvestment into the business. The dividend growth signals confidence from management and a shareholder-friendly approach. Cash flow from operations remains strong, allowing both returns and internal investments to coexist. From a value perspective, Innospec doesn't scream bargain at first glance, but dig deeper and you'll see a company trading at reasonable multiples given its stability, niche dominance, and zero long-term debt. Its return on invested capital is solid, and management has proven disciplined in capital allocation. The recent drop in the stock price has narrowed the gap between price and intrinsic value, making it more interesting for patient investors. So, what are the risks? The business is exposed to energy markets, especially through its oilfield services unit, which means commodity price swings can have an impact. Additionally, regulatory and environmental pressures are always lurking in the chemicals industry. Still, Innospec has been proactive in moving toward cleaner, more sustainable solutions, which could serve it well over the long term. Why consider the company now? The market may be overreacting to short-term softness in one segment. The core business is intact, the balance sheet is clean, and long-term demand for specialty chemicals, especially in the personal care and fuel additive spaces, is expected to remain steady or grow. On the other hand, if macroeconomic uncertainty persists or energy markets remain volatile, recovery could take longer than hoped. So it's not a rush-in story. It's more of a steady compounder that may be momentarily discounted. At Insightful Value, we break down companies like this with clarity. We cut out the jargon and get to what really matters in an investment story. Whether you're just starting out or you've been in the game for years, our content is designed to bring sharp, actionable insights to your screen. Check out insightfulvalue.com for more detailed write-ups and fresh analysis. If this kind of value-focused look is what you're into, give this video a like, subscribe to the channel, and don't forget to visit insightfulvalue.com for more.